What does it mean when a market reaches a price level it has never been able to sustain or reject before? That is the question silver is answering right now. In early 2026, silver is no longer trading within a familiar historical framework. It has crossed into what markets define as blue sky territory, a condition that appears only once or twice in a generation. For the first time in 45 years, silver has broken above every meaningful historical peak, dating back to January 1980. That 1980 high acted as a structural ceiling for more than 4 decades. Every major rally since 1998, 2006, 2011, and even the post-COVID surge in 2020 failed below that level. Each advance was met with selling pressure from traders anchored to past highs, creating persistent overhead resistance. That regime ended in late 2025, when silver decisively cleared all prior peaks and invalidated the entire historical resistance zone. Resistance, at its core, is market memory, and in blue sky territory, that memory disappears. Without it, traditional technical tools such as prior highs, long-term trend lines, and historical resistance bands lose their predictive power. Before we go deeper into what replaces those tools and why momentum and behavior become dominant drivers, make sure you subscribe to GB Economy for clear, data-driven macro analysis grounded in structure and history, not hype. In blue sky conditions, price is no longer negotiated with sellers from the past. It is discovered in real time, driven by momentum and the psychology of FOMO. When that shift occurs, markets stop moving incrementally and start accelerating. If blue sky territory defines where silver has arrived, the violent drop that followed explains how the market was forced to get there cleanly. After surging to an intraday peak near $121 in late January 2026, silver collapsed to approximately $63 in less than a week. To many observers, that move looked like a classic blow-off top. Headlines declared the rally over. Analysts called it a failed breakout. But price action alone does not determine structure, and this decline did not break it. What occurred was a liquidation event, not a trend reversal. The speed and magnitude of the drop point to forced selling, not a change in long-term conviction. Margin calls cascaded as volatility spiked. Leveraged futures positions were unwound. Stops were triggered automatically. This is the same mechanical process seen in 2008, when silver fell over 60%, and again in March 2020, when it collapsed from $18 to $12 in days. In each case, the selling was indiscriminate and temporary, and in each case, it marked the removal of excess leverage rather than the end of a bull market. The January 2026 decline achieved exactly that. It flushed out weak hands, eliminated over-leveraged traders, and removed participants who entered purely on short-term excitement. Those sellers are now gone. What remains are holders who either accumulated below $70 or who understand that the breakout above 4 decades of resistance fundamentally changed the market's trajectory. Crucially, the liquidation did not push silver back below its long-term breakout zone. The market did not re-enter the 4 or 5-year range that capped prices from 1980 to 2025. That means the breakout remains valid. Blue sky territory still exists above current prices. The crash was not a rejection of higher levels, it was a structural reset. And once leverage is purged and speculative excess removed, history shows that markets emerging from blue sky do not reverse. They consolidate, rebuild, and prepare for the next acceleration. With excess leverage flushed out, what matters next is who is left to sell and who is waiting to buy. That is where the current market structure becomes critically important. As of early February 2026, silver is trading near $77, and the structure beneath that price is distinctly asymmetric. Downside risk is increasingly constrained, while upside pressure remains open. On the downside, support is clearly defined and unusually strong. The zone between $64 and $55 has been tested repeatedly since the late January liquidation and has held each time. This area represents the intersection of physical buying, long-term accumulation, and post-liquidation value recognition. It is not a fragile technical level, it is a structural floor reinforced by capital that was waiting for volatility, not fleeing from it. Each dip toward this zone has attracted aggressive buying, confirming that demand is patient, well-capitalized, and conviction-driven. Above the market, resistance is notably weak. The nearest meaningful level is $90, but unlike historical ceilings, it lacks depth. There is no multi-year congestion, no large population of trapped sellers, and no legacy supply built over time. Most participants who wanted to sell above current prices already did so during the liquidation from $121 to $63. That event exhausted the available selling pressure. As a result, very few holders at $77 are motivated to exit, while a large group of sidelined buyers remains. These buyers share one characteristic. They missed the initial breakout in late 2025. They watched silver clear 4 decades of resistance, hesitated, and then waited for a pullback that finally arrived. If price revisits the lower end of the range, their response is unlikely to be cautious. It will be urgent. This creates an imbalance where declines invite demand faster than rallies attract supply. That is the definition of an asymmetric structure. When support is dense and resistance is thin, probability tilts upward. Not because price must rise immediately, but because the path of least resistance no longer points down. An asymmetric structure only becomes truly powerful when investors understand where a correction is occurring. A pullback inside a long-standing resistance zone carries a very different message than a pullback that happens after a breakout. This distinction is critical to interpreting silver's behavior in 2026. Corrections below resistance tend to confirm ceilings. Corrections after breakouts tend to clean markets. When silver corrected repeatedly between 2011 and 2020, it did so below its historical highs. Each decline reinforced the same message. Sellers were still present, overhead supply remained heavy, and the market had not earned higher prices. Those pullbacks validated resistance and ultimately capped every rally. That is what a failed market structure looks like. What unfolded in January 2026 was fundamentally different. Silver had already broken above its 4-5-year ceiling dating back to 1,980. The decline from $121 to $63 occurred above that historical barrier, not beneath it. That alone changes the interpretation. Instead of validating a ceiling, the correction functioned as a purge, removing leverage, speculation, and emotional excess from a market that had just transitioned into blue sky territory. This process is not unusual. Gold followed a similar path after breaking out of its multi-year range in 2019. After clearing $1,360, gold corrected sharply, consolidated for months, and frustrated both bulls and bears before accelerating to new highs in 2020. The correction did not negate the breakout, it prepared the foundation for continuation. Once the shakeout phase is complete, the market's behavior changes. Sellers are exhausted, weak holders are gone. The remaining participants are structurally aligned with higher prices. At that point, the path of least resistance shifts decisively upward, not because optimism increases, but because opposition disappears. In blue sky conditions, corrections are not warnings. They are resets. And history shows that after those resets, markets rarely drift sideways for long. Once the structural distinction of a post-breakout correction is clear, the next step is to evaluate relative value, not nominal price. And when silver is measured against other major assets, the conclusion is unmistakable. Despite recent gains, silver remains historically cheap. This is most evident when silver is compared to the S&P 500 and to a traditional 60/40 portfolio of stocks and bonds. As of early 2026, the ratio of the S&P 500 to silver remains near multi-decade extremes, hovering close to levels last seen during periods of deep market imbalance. In 1980, when silver reached its prior peak, that ratio collapsed into single digits. In 2011, it compressed toward the low 30s. Today, despite silver trading near $77, the ratio remains closer to 80-90, signaling that equities are still historically expensive relative to silver. From a relative standpoint, silver has barely begun to mean revert. The same pattern appears when silver is measured against a 60/40 portfolio. Over the past century, silver has formed a massive double bottom relative to balanced portfolios, with the first low occurring during the 2008 financial crisis and the second during the 2020 pandemic liquidation. These were not ordinary troughs. Both represented forced selling, systemic stress, and indiscriminate liquidation across asset classes. Historically, double bottoms of this scale do not resolve with short-lived rallies. They mark regime changes. Since mid-2025, silver has begun to break upward from that long-term base. Importantly, breakouts from multi-decade relative lows do not reverse quickly. They tend to unfold over years, not months, as capital gradually reallocates from overvalued financial assets into scarce, tangible ones. From this perspective, silver's recent volatility is not evidence of excess. It is the early-stage turbulence of a much larger relative repricing that has only just begun. Relative valuation explains why silver is cheap. Supply-demand dynamics explain why it cannot stay that way. Beneath the price action and the volatility of early 2026, the The physical silver market is tightening in ways that are structural, not cyclical, and those pressures overwhelmingly support higher prices over the long term. On the supply side, silver production has effectively plateaued. The largest, highest grade, and easiest to extract deposits were discovered and developed decades ago. According to industry data, global mine supply has struggled to grow meaningfully since the mid-2010s, despite rising prices. Bringing new silver mines online is neither quick nor flexible. From initial discovery to commercial production, the process typically takes 7 to 10 years, requiring billions of dollars in capital, regulatory approval, and sustained price incentives. Supply cannot respond to demand shocks in real time. At the same time, demand is accelerating across multiple fronts. Solar energy alone has become a dominant driver. Each photovoltaic panel requires silver for conductive paste, and global solar installations reached record levels in 2024 and 2025, with further expansion projected through 2030. Electric vehicles add another layer of pressure. EVs use significantly more silver than internal combustion vehicles due to power management systems, sensors, and onboard electronics. Beyond energy and transportation, silver remains indispensable in electronics, medical devices, and industrial applications where substitution is limited or impossible. Crucially, monetary demand has returned. After more than a decade of neglect, investors are once again treating silver as a monetary asset rather than a niche commodity. Physical coin and bar purchases have surged since 2023, while institutional interest has expanded alongside growing concerns over currency, debasement, and sovereign debt. This combination constrained supply and expanding industrial and monetary demand creates a structural deficit. And structural deficits do not resolve through lower prices. They resolve only when prices rise high enough to ration demand and justify new supply. That is the economic reality now embedded in silver's long-term trajectory. Even with a tightening supply-demand backdrop, markets do not move in straight lines. After a structural breakout and a violent liquidation, the dominant phase is rarely immediate acceleration. More often, it is accumulation. That is precisely where silver appears to be in early 2026. Price action since the late January collapse has shifted from expansion to digestion, a necessary process after extreme volatility. Historically, this phase can persist far longer than most participants expect. Following its breakout in 2019, gold spent nearly 18 months trading sideways between $1,500 and $1,700, frustrating both bullish and bearish traders before resuming its advance in 2020. Silver is now exhibiting similar behavior. Since rebounding from the $63 low, price has oscillated within a broad range, with sharp intraday swings and repeated false starts. These moves are not signs of weakness. They are characteristic of markets rebuilding a base after leverage has been flushed out. This environment is uncomfortable by design. Rallies stall and reverse. Pullbacks fail to follow through. Volatility remains elevated. Short-term traders lose patience as neither trend-following nor mean reversion strategies work consistently. That is not an accident, it is how markets transfer ownership from reactive participants to those with longer time horizons. For investors, the implication is clear. This is not a phase suited to short-term speculation or leveraged positioning. It is a period where time, not timing, matters most. Those willing to accumulate gradually during consolidation tend to benefit once the next directional move begins. And history suggests that when accumulation phases follow structural breakouts, they do not end quietly, they end with resolution and renewed momentum. Accumulation phases do not eliminate risk, they redefine it. In the short term, silver remains vulnerable to exogenous shocks, particularly deflationary events tied to liquidity stress rather than fundamentals. History provides a clear precedent. In March 2020, as global markets seized up and margin calls cascaded across asset classes, silver collapsed from nearly $18 to $12 in less than 2 weeks. That move had nothing to do with supply, demand, or long-term value. It was mechanical. Funds sold whatever they could to raise cash. The same dynamic could occur again. A sudden tightening in financial conditions, a credit event, or a systemic liquidity freeze could temporarily push silver below established support levels. In such scenarios, prices could test the mid-$50s or even lower. But these declines should not be confused with structural failure. Deflationary sell-offs in silver are driven by forced liquidation, not by deteriorating fundamentals. What matters is what follows. In 2020, silver more than doubled within 6 months, rallying from $12 to over $30 once liquidity returned and panic subsided. That recovery was swift, precisely because physical demand never disappeared. The same principle applies today. Supply constraints remain intact, industrial demand continues to grow, and monetary interest has re-emerged. A temporary air pocket does not erase those realities. From a risk-reward perspective, liquidation-driven declines are asymmetric opportunities. The lower price falls during forced selling, the more downside risk compresses relative to upside potential. That is why experienced investors differentiate volatility from risk. Volatility is noise, risk is permanent impairment. In structurally tight markets, liquidation events tend to transfer assets from weak hands to strong ones. For those with capital and patience, short-term shocks are not reasons to exit, they are moments when long-term probabilities improve most dramatically. At its core, this is not a story about whether silver is trading at $77 or $90 in early 2026. Focusing on those numbers misses the point entirely. What matters is not the next short-term fluctuation, but the structure beneath it, the probabilities that structure creates, and the long-term cycle now unfolding. Price is merely the surface expression of those deeper forces. Markets rarely offer clean, repeatable opportunities, but history shows that blue sky breakouts, where an asset clears all historical resistance, are exceptionally rare, occurring perhaps once or twice in a generation. Silver's breakout above a ceiling that held since 1980 places it firmly in that category. When such events occur, they do not resolve in weeks. They initiate multi-year repricing processes marked by volatility, skepticism, and long periods of consolidation that test conviction. This is why preparation matters more than prediction. The most important work is done before acceleration begins. During the uncomfortable phase when prices chop sideways, headlines fade, and attention shifts elsewhere. That is when positions are built quietly and risk-reward is most favorable. Chasing momentum after confirmation feels safer emotionally, but historically it produces inferior outcomes. Probability now favors continuation over reversal, not because silver must rise tomorrow, but because the structural conditions that suppressed price for decades have been removed. The market has changed regimes. Understanding that shift is far more valuable than reacting to daily candles or weekly noise. Thank you for watching. If you found this analysis useful, your support helps the channel grow. And if you see the market differently, share your perspective in the comments.